What's good, everybody? Y'all know who it is. It's your boy, the Grandmaster Troll, here to give you some not the best trolling. Oh, my thing froze already? My thing froze already. It's your boy, the Grandmaster Troll, here to give you some of the best stock advice on YouTube. So we got a couple of people in the building. My man JBM93. He's the first unmodded person in the chat. So he won the free wrench of the day. We got Reed Jones. We got Dwayne in the building. I'm going to keep this one rather short and still keep it on the fundamentals of stocks. So we're going to talk about understanding the difference between stocks, mutual funds, index funds, REITs, and MLP. So we're gonna break those down real quickly. Then I might chop it up with you guys. We got Sequoia L in the building. Oh, I'm really be able to focus in on the chat right now because there's not a lot of people watching. So I really be able to answer your guys' questions if you guys have any questions. But we're gonna talk about the pros and cons between stocks, mutual funds, index funds, REITs, MLPs, mortgage REITs, and what they are, and give some stock opinions. I am not. Hold on. Let me slide back up. Let me slide back up here. I am not a financial advisor. I'm a Negro on YouTube who calls himself the Grandmaster Troll. It is up to you to seek a financial advisor and be able to mitigate your risks. What I say is for educational and entertainment purposes only. So if I put up a stock on here and you put $1 million in that stock and that stock goes under, you cannot come after the Grandmaster Troll because I am not a financial advisor or expert. I'm just a Negro on YouTube. So with that said, let's get right back into the good stuff. Be sure to check out the links in the description in regards to the GMT brand. I finally got the Grandmaster Troll channel up in there. I'm gonna put some content on there today. Then we got stuff in regards for Grandmaster Troll Racing, different Facebook groups and things. If you guys want to get involved, if you're in the Bay Area and you want to go to the track, you want to go 100 miles on the canyons and go on a couple of car rallies or events, there's some goodies in there as well as my other channel. But be sure to support the channel. Be sure to support the channel. Hit the like button. Leave a comment. $, the Grandmaster Troll, or if you have a question, put it in the super chat. I'll be more than glad to answer any questions. We got Shelly Long in the building. Hold on, we got Incognito in the building. My phone is going off because of all these stock notifications. I just bought a couple of stocks. We're going to talk about that as well. Somebody says you should make a little icon that says I am not a financial advisor. This is just for entertainment like the other text on the screen. Yes, I'll also look into that as well. Hold on, there's something wrong with my logo right here. We gotta spice up the logo real quick. Let's see if I can find the logo that I want to be using. There we go. That's the one I want to be using right there. So we're going to make the other logo go away. Let's drag this over this logo right here. Make it a little bit bigger. Put it directly over the top. Look at that. You can't even see the original logo. I even have to make that logo go away. But I will. Let's take this and we're going to slide this down below the logo. There we go. Now let's get into business. We're going to talk about The pros and cons between stocks, mutual funds, index funds, REITs, then actually go specifically and break down the different kind of REITs that there are. Let's see if I can find my tab. There we go. So we got individual stocks. The pros, the benefits for individual stocks is reduced. There's no fees. So that's when you buy a stock before Robinhood, before everybody offered free trading. If you had a brokerage account, let's say in the 90s, early 2000s, mid 2000s, whenever you bought a stock, you would have to pay a fee for buying a stock. So if you had $100 and you wanted to buy stocks, well, the fees were $35. So a lot of people didn't get involved in stock trading because the fees were high. But today with Robinhood and different other brokerages, M1 Finance, who offer, let me put this on mute, who offer people to use sign up for a brokerage account, you don't have to pay any fees. So when you buy a stock, there's no fees and there's no managed fee to own. With index funds and mutual funds, you have to pay a person either to actively or passively manage that fund. But when you buy a stock, there's no management fee because the stock, it's one stock, so it runs itself. And then you have complete control over the stock. You decide when to sell it. You decide when to buy it. You have your own understanding of what you own. So if you want to buy a stock, you're able to pick. You're able to pick the exact price you want to buy that stock. If you want to buy an option or do a put call of that stock, you could do that as well because you have complete control of that stock. And that's one of the benefits. And taxes are easy to manage. You got your capital gains, you got your capital loss. If you hold the stock for over a year, you don't have to pay as much taxes on it. So now some of the cons or the bad things or things that are not as a benefit to buying a stock is that it's hard to diversify. You need 20 to 100 to achieve adequate diversification. Like I said before, there's a bunch of sectors in the stock market. There's 11 different sectors, and then within those sectors, there's also other subgroups as well. So you have to buy many stocks in order to achieve diversification. Diversification is important because if you just buy one stock all the time and let's say that stock goes under or breaks some law or the CEO does something or if the government makes up a disease called COVID-19 and you put all your money in Carnival Cruise Line and all of a sudden there's no cruises for over a year, possibly 2 years, well then that's gonna hurt at your earnings. So when you buy stocks, it's harder to diversify because you got to buy more stocks in order to achieve diversification. Then there's more effort and time to monitor your portfolio. So if you have 20 stocks and you want to be able to keep up with the growth and the development of that stock, well, you have to do a lot of your own research. You have to put a lot of time into reading articles, listening to conference calls, reading the financials, the income statements, balance sheets, cash flow, trying to keep up with the company is trying to do. And it really takes a lot of time. Then you also have rebalancing. So let's say you have 10 stocks and they're pretty much even. You have 10 stocks, they're each 10% of your portfolio. Let's say one stock goes down 3%, another stock goes down 8%, and then you have another stock that goes up 100%. Well, that one stock that shot up is now going to be the majority of your portfolio, and you want to rebalance because you want to achieve that diversification. And then another thing you have is FOMO. FOMO stands for the fear of missing out. We all don't want to miss out. We all saw Bitcoin run up 2018. We saw average people become millionaires. They were buying Bitcoin cars, which were Lamborghini vehicles. They made so much money on Bitcoin, they were able to just use their Bitcoin to buy a Lamborghini. And there was this, and people did not want to miss out. So a lot of people, including myself, bought at the top of Bitcoin because we didn't want to miss out. Then the next thing you know, Bitcoin had crashed, and a lot of people lost a lot of money because they had the fear of missing out. And then people get their emotions tied up into individual stocks. So when you get your emotions tied up to individual stocks, it's like having your emotions tied up into that beautiful female that you're in a relationship with. She doesn't follow your directions. She's very uncooperative. She's not submissive. She's putting you on child support. But since she's the love of your life, your emotions keep you attached to that possibly toxic girlfriend. The same thing could happen with a stock. You could get emotionally attached with a stock, and even though the financials is telling you that the company is not doing good, the balance statement is telling you the company's not doing good. You got cash flow is not doing good. The company done cut the dividend, but you believe in that stock so much that you overlook the financials. You really believe the company is going to turn around. You really believe they're going to increase the dividend after they had cut the dividend. Shout out to my man Debo. He says class is in session. Salute GMT. You get emotionally tied up with a stock. Either you're a customer of that company and you just been going to this company for the past 20, 25 years doing business with this company, but the company has turned into a dinosaur and there's other competitors in the market who's going to take market share for that company, but you're blinded to see it because your emotions are caught up into an individual stock. So those are some of the pros and cons of investing in individual stocks. We're going to go ahead. We're going to talk a little bit about mutual funds, but before I do that, we all know where to go buy individual stocks. You could buy them on Robinhood, M1 Finance, TD Ameritrade, Fidelity, Webull. There's a bunch of different apps. In fact, if you don't have a brokerage account, if you look in the description section, if you hit a link for Robinhood and sign up, you'll get a free stock. And if you go to Acorns, you don't have an Acorns account, I'm going to talk about Acorns when I talk about mutual funds. You could sign up on Acorns, and if you could get other people to referral, you get some free money that will go to your portfolio. So your boy GMT, hold on. Your boy GMT, I'm trying to look out for you guys out there. I'm trying to put money in your pocket right now. I'm trying to give you some free stocks. They told me Neon Eyes didn't have a brokerage account yesterday. She didn't own any stocks. I gave her the link and I haven't received my free stock yet, which means Neon Eyes hasn't received her free stock. And I'm waiting on you Negroes to get up off your butt and actually get in the investing world and try to make you a little bit of money. But let's talk about mutual funds. Mutual funds. Yes. So when you put money into a mutual fund, the pros is there's reduced fees. There's no management fee to own. Well, that's individual stocks. Hold on, I'm tripping. I knew something wasn't right. There we go. So mutual funds is pool of money from the public to buy securities. So the pros of it, it's very liquid. No, it's well diverse. It's professionally managed, either actively or passively. More times than not, it's active. So that means there's a person in charge who's running the fund. There's lots of options. You have balance, you have fixed income, money market, all kind of dividends you could receive and benefits you could receive. Some of the cons are there's the hot. It's a higher fee because you're paying some millionaire, billionaire person to actively manage the fee, and that person gets their cut, rather if the fund performs outstandingly or if the fund performs poorly over a certain amount of time. Is not FDIC insured. There's large cash holdings, so the fund will actually hold a large amount of cash, and we all know saving a large amount of cash is bad because you're fighting against inflation, and that money can be used to go to different things. And then next, it's hard to evaluate apples to apples. So if you want to compare mutual funds to different mutual funds, it's hard to do. So a lot of people's 401ks, IRAs, Roths, those are a lot of what mutual funds are. If you want to sign up for a mutual fund, a place that you can go to is Vanguard.com. When I'm told they're the king of mutual funds, so you could go over to their website. You could sign up for a mutual fund over there. But I'm gonna play this video right here. Why is this right here? That's there from yesterday. Hold on, make that go away right there. But I'm gonna play this video in regards to mutual funds so you could get a better understanding about it, and I could take a drink of my wine, my wine right here, and rest my voice for a couple of seconds. So with that said, I'm gonna play the video.
Together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund. Mutual funds can potentially benefit investors in several ways. They are a way to make a diversified investment. Most are managed by financial professionals, and because of the wide variety of mutual funds, they allow investors to participate in a wide variety of investment types. Let's walk through an example of how a mutual fund works. Suppose there is an investor who wants to invest some of his retirement portfolio in the stock market, but he doesn't have time to analyze individual stocks and create a diversified stock portfolio. Instead, he decides that he'd rather purchase a mutual fund. This way, the investor can purchase a single investment, which will be similar to purchasing an entire portfolio of stocks. But which mutual fund is right for him? To find the right one, he uses online tools such as mutual fund searches and ratings given by independent third-party organizations to find a mutual fund that meets his investing goals. Once he finds a fund that looks like a good fit, he reviews the fund's prospectus, which is the official summary and explanation of how the fund operates. The prospectus provides a variety of information about the fund, including its fees and charges, minimum investment amounts, performance history, risks, and other useful information. After researching the fund and its prospectus, our investor decides that this fund looks like a good investment. So, he buys the minimum required investment amount and purchases shares of the mutual fund. By owning shares, the investor now participates in the gains and losses of all companies held in the fund. A benefit of this is diversification, which is when an investment or portfolio is spread across several different investments. Doing this can help lower risk. For example, if one company that the fund invests in has a rough year, the impact on the fund's total assets can be small, because that struggling company is only one fraction of the fund's total assets. Like most other mutual funds, the fund the investor chose is actively managed, meaning it is run by a fund manager or managers who buy and sell the fund's assets. Fund managers aim to provide the biggest returns they can for investors by using financial analysis and professional expertise. While a talented manager could earn good returns for the investor's fund, there is no guarantee of success. If a manager makes choices that don't pay off, our investor won't earn the returns he was hoping for. However, even if the fund doesn't perform well, the manager still collects a fee, which is paid from fund assets, meaning even lower returns. Management fees aren't the only costs our investor has to pay either. Besides transaction fees, the fund may have a sales load, which is a charge to either buy or sell shares. Some funds also charge an additional load if shares are sold within a specific time frame. Now that the investor is bought into a fund, how might he make money from it? One way is through appreciation, which is when the fund's shares go up in value. Typically, when the fund's assets rise in value, the fund's shares do the same. Unlike a stock, the value of a fund's shares does not change throughout the trading day. Instead, the fund's value is calculated and updated when the market closes. Another way an investor might make money through a mutual fund is from a dividend payment, which is when a mutual fund pays out a portion of its earnings to shareholders. However, when the fund's assets fall in value, the fund's shares do the same, which is a risk of owning a mutual fund. One benefit to mutual funds is the variety of mutual funds available. Our investor chose a mutual fund that invested in stocks. However, there's a mutual fund for almost every type of investment. For example, equity funds buy stocks, fixed income funds buy bonds, and balanced funds buy both. Some mutual funds may invest in a whole index, while some others focus on stocks of a certain country or market sector. Certain funds have different objectives as well. Some may look for riskier stocks in growing industries, while others will invest in more stable companies. There's a lot to learn about mutual funds and other investment options, and we've got the resources to help you get started. Take a look at more of our award-winning investing education.
All right, so we're going to send a special shout out to the TD Ameritrade for that video. Some people said they felt like they're in class. That's right. I'm gonna give y'all an education today. But that's the thing about mutual funds. As you can see, one of the big takeaways I took away right here. We got the. Let's see if I pull them up. We got the great fund manager right here. You know, the white man in his suit. They still didn't put a brother in the suit as a fund manager. So there's a little bit of that stereotypical thing going on that a lot of people in this sector of YouTube don't like. But we're going to move on. We're going to move on to index funds because somebody wanted me to talk about ETFs. So we're going to talk about index funds a little bit and how they differ from mutual funds. So we come here. Okay, index funds are a basket of stocks to mimic a certain market index. The pros is there's low fees. They outperform active management over time. It's easy to own, manage, invest in, and achieve goals. The cons is there's no control over holdings. There's a lack of downside protection. No, it's not a hedge fund, and it lacks of different strategies. So when you buy your index fund, you don't control the holdings. So index fund that I recently bought today, I bought some shares of this fund right here. Something I have a little bit of history with. So we're gonna go to their website real quick and we're gonna break it down a little bit. Let me see if I can make myself a bit more smaller. I'm still too big, a little too big for my liking. Let's see. Give me that black square I'm clicking on right there. There we go. No, you weren't supposed to do that. Okay, so I bought this ETF right here. And so with all these different funds and stocks, they all have a website where you could go to and you could go get information from. Like I said, in order to be a great stock investor, you have to do your own research. If you want to get 20%, 30%, 50% year over year, you have to do your own research. That's what them rich people do. They do their own research. So when they're able to turn 100,000 into 1 million just by putting money in the stock market, they're able to do that because one, they're able to mitigate their risk because they have firsthand knowledge of these companies and things that they're going to look to do. But it gives you the summary of the funds. So the Global Cloud X Cloud Computing ETF seeks to invest in companies positioned to benefit from the increased Adoption of cloud computing technology, including companies whose principal business is in offering computing software as a service. That's what that is. The fund objective is to seek to provide investment results that correspond generally to the price and yield performance before fees and expenses of the index cloud computing. Let's see, you look to the right, they'll give you the ticker symbol, the inception date, tells you what exchange it's on, tells you a little bit about the fees and the distribution. And then if you slide down, it gives you some performance history, it gives you the fund price, a little information, but the part I want to focus on is it gives you all of the companies that are in the fund and the percentage of that company that the fund makes up. So the top 3 in this fund are a company called ZS Caller, Proofpoint, Shopify. We got Twilio is in here, Workday is in here, Dropbox, Netflix is in here, Salesforce is in here, Zoom is in here, Microsoft, Amazon, Google, or not Google. Yeah, Google's in here, Alphabet Incorporated. We got Alibaba. So it gives you a list of companies. Now with index funds, the companies are already listed out for you to partake in. So I can't, let's say if I don't like Shopify and I want to put, if I wanted to put Apple in here, I can't substitute my 4% holding in Shopify, take it out and put that 4% with Apple because I gotta go with the fund has. So that's a little bit about index funds. I know some people in the chat that they have index funds, and you got index funds for like cloud computing software. You got them for every different sector that's in the stock market, just depending on the fund. To find some of these funds, you just go on your Robinhood or you go on Google, you put in ETF, and you literally get thousands of index funds that you could choose from. But let's see the differences between index funds, or what are index funds exactly. So I'm gonna play this video, another educational video. I got a couple more to play after this one.
Such as the S&P 500 are known as index funds. Index funds include both index mutual funds and index exchange traded funds, or ETFs. These funds typically use a passive investing strategy, which means their objective is to deliver returns similar to an index of investments. However, index funds usually deliver returns that are slightly lower than an index due to fees associated with these funds. In this video, we'll discuss how index funds work, identify some of the indices these funds track, and examine benefits and risks associated with this type of fund. Simply put, index funds are built to have a similar performance to that of a major market index. This means they tend to be diversified in securities across that index and include a number of investments. There are many market indices and index funds that follow them. For example, if you want to invest in U.S. stocks, you might invest in a fund that tracks an index like the S&P 500, which follows the 500 largest stocks in the market, the Dow Jones Industrial Average, which includes 30 large-cap industrial stocks, the NASDAQ 100, which follows 100 large-cap technology stocks, or the Russell 2000, which tracks 2,000 small-cap stocks. For international stocks, an example of a widely tracked index is the MSCI EAFE, which includes large-cap stocks in developed countries across Europe, Australia, and the Far East. For U.S. bonds, an example of a widely tracked index is the Barclays Capital Aggregate Bond Index, which includes a mix of government bonds, mortgage-backed securities, and corporate bonds with different maturities. As you can see in these examples, index funds can track different assets, including stocks and bonds. There are even index funds that follow commodities, currencies, and other assets. But regardless of which type of asset they track, an index fund still has its risks. Put simply, index funds are exposed to the same risks as the index they're following. For instance, if the S&P 500 declines in value, then the index funds which track it will follow suit. An index fund that tracks bonds is at risk if interest rates rise and bonds decline in value. Some investors are willing to accept these risks and choose to invest in index funds because of the potential benefits they might offer. A primary benefit is the typically lower expense ratio, which is the ongoing cost of investing in the fund compared to actively managed funds. As the name implies, actively managed funds use an active investing strategy. This means that they frequently buy and sell investments. This typically results in higher costs or expense ratios and can be a drag on a portfolio's performance over time. Because index funds are passively managed and simply track an index, they generally have a low portfolio turnover, which means they infrequently buy and sell investments. Infrequent buying and selling typically translates into low expense ratios. The low expense ratios of index funds can possibly lead to more growth when compared to the higher expense ratios of similar actively managed funds. Let's look at an example. Suppose an investor purchases $50,000 of two funds that both grow 7% per year before expenses over the next 30 years. The funds are similar in all respects except expense ratio. Fund A is an actively managed fund with an expense ratio of 1.2%. This fund would grow to $271,356. Fund B is an index fund with an expense ratio of 0.2%. This fund would grow to $359,838. That's a difference of $88,482, and it's all thanks to a low expense ratio. The low cost of passively managed index funds can make a difference, and is a reason index funds may outperform actively managed funds over long time periods. This is why some investors take the "if you can't beat 'em, join 'em" approach and use index funds to simply track market indices.
So as you can see, those were index funds, and that's why they're a little bit better than mutual funds, because index funds are passively managed as opposed to actively managed. So if my man Rollo gave me $1 million to manage and I was able to buy and sell, I'll be able to charge him a higher fee. But if he put that same $1 million into an index fund, which basically manages itself, because the person isn't in charge isn't buying or selling as much as the person who's actively buying and selling, well, the fees are going to be lower, and Rollo's going to get a better return on his $1 million that he wanted somebody else to manage for him. So those are some of the pros and cons and what an index fund is. I haven't seen anybody put in the index fund. Somebody asked the question, so are the banks like Bank of America getting over? They're not getting over, and the reason they're not getting over because they're providing their people a service. Those people give them their money to hold, and Bank of America takes the money that they have given them to hold, and they'll take that money and they'll go multiply that money. Now, the person who put the money in that bank could have did the same thing that the bank does, but they want the bank to hold their money for security reasons, because they don't want to keep it in the mattress in their bedroom, because if they do that, we all know how they do in the hood. If somebody knows you got $1 million in your mattress in your bedroom, they're going to try and rob you and do this, that, and the third. But when you put that in the bank, people aren't really going to rob a bank because they know the police is going to get involved. They're going to have that bird over their head. So money in the bank is a little bit more secure than money in a mattress. But are banks getting over on people? No, because people willingly give their money to the bank. If you want a better return on your money, you gotta do what the banks do. And one of the ways you could do that is investing. We got Deja Vu Griffin coming through with a $20 super sticker that says "You are amazing." Salute to Deja Vu Griffin for supporting the channel. But next, we're gonna talk about one of my favorite investments. We gotta talk about the REIT sector. So a REIT is a company that owns, operates, or finances income producing real estate. Some of the advantages, some of the pros are access to historically unaccessible asset class. It's liquid, stable cash flow through dividends. They have to pay out 90% of income. Historically, a sound asset class. Some of the disadvantages are dividends are taxed as regular income. It's subject to market risk and economy downturn, and have high management fees. So basically, a REIT is a real estate investment trust. So think about if you wanted to buy a house, you would have to have the right credit, you would have to come up with the down payment, and you would have to be able to pay the mortgage in order to keep whatever real estate property that you bought. But with a real estate investment trust, you now have access into owning some real estate. You could get into hotels, you could get into residential real estate, you could get into non-residential real estate, you could even get into mortgage REITs, and we're going to talk about a little bit about mortgage REITs and what they are as well. So I'm going to show you, see if I could pull up the website of what was one of my favorite mortgage REIT that I was invested in. I'm gonna pull up their website right here, see if I could find it. Here we go, right here. Okay. See if we could pull up. So one of my favorite real estate REITs before COVID hit was Apple Hospitality REIT. They're a hotel real estate investment trust. You know, I was looking at investments within the REIT sector, and I came across this REIT, and I said, hotels. I've stayed at a few hotels. Let me see what this has to offer. I liked what I saw. I bought a couple of shares. I had the active cash flow. I was getting some capital appreciation. Everything was going good. But like it says right here in the cons, they are subject to market risk and economy downturn. And when COVID had hit, you know, people really weren't traveling as much. They couldn't travel. We had all these COVID restrictions. No, companies were scared. They had to follow certain protocol and procedures. So when the whole pandemic hit, of course, the hotel industry took a big hit because people weren't staying there. So they had to cut their dividends, so I wasn't able to get the cash flow, and I ended up losing some money into this REIT. But when you go back to their website, because we got to do their own research, you're able to see their hotel portfolio. So it gives you a map of their hotel and their hotel brands. So we're going to look at a couple of hotel brands right here. That you see, they have Embassy Suites, they have Hampton, they have Hilton, Homewood Suites, Hyatt, Courtyard, Marriott, Residence Inn. But more importantly, I don't think they own every single one, but they give you a map of all of the hotels that they own throughout the country. So you can see they got some hotels right here in California. I think this one right here is closest to where I live. So in California, they got one in Burbank, California, which is right across the San Mateo Bridge. In fact, they got a couple in Burbank, California. Oh, they got a lot. They got some in Clovis, which is in the Fresno area, Cypress, then Oceanside, Sacramento. So you could literally see the investments that the hotels that they own, and you could literally see the hotels. If you want to stay at the hotel, you can literally stay at a hotel that you have part ownership on. So when you pay the hotel that money, you know, hold on. I got a troll. I got a troll. So if you are one of these tricking Negroes here on YouTube, and you know you like to trick on these OnlyFans escorts. You know, if you like Mr. Kevin Samuels, as they say, and he's tricking on high price escorts going to hotels in the middle of the night. I'm telling you, when this whole pandemic thing is over, and them hotels start popping again, and people, Negroes got some more money to trick with, you are gonna want to be invested in hotels, because that's where these Negroes go. So that's basically REITs. I think I have a video on REITs as well, so you could get a better understanding of how REITs work, because there's a lot of different sectors. So we're going to go ahead and play that video as well. But before I do that, my man Sick Lid coming through with a $5 super chat. He says, only 20 people here are lost. I mean, I'm telling you, Slick Lid, I talked about Kevin Samuels. That view got 11,000 views within 3 days. I talked about stocks. It got less than 1,000 views. But hey, that's the way it goes. But be sure to subscribe to the Grandmaster Troll Money channel. I'm going to put these lives over on that channel as well, and also do some content which I'll post on that channel first, and then I'll post it on this channel last, because I need to get my AdSense money, because I know y'all Negroes ain't gonna subscribe to my Grandmaster Troll channel. And the reason we know that, because all we gotta do is count the views between my troll videos and my investment videos. And like my man Slick Lid said, people are lost. But let's go ahead and learn about how REITs work.
REITs, or Real Estate Investment Trusts, were created by Congress in 1960 to give all Americans the opportunity to benefit from investing in income-producing real estate.
Stop the show right there. God damn, I haven't even watched this video. I haven't watched though. I had no idea that Congress, your politicians, made it possible for Negroes to invest in real estate. That's interesting right there. That is interesting right there. Let's see, Sick Lid come through with a $5 super chat. He says, you reading my mail, GNT. These strippers are hurting Big Bank Hank here to save the day. But yeah, Congress, let me go. I'm going to play the whole video over, because I had no idea Congress back in 1960s made real estate investment trusts available to the average day American. So when all these people say they were locked out of certain opportunities, we could say, well, back in 1960s, you could have put your money in one of these billion-dollar REITs.
REITs, or Real Estate Investment Trusts, were created by Congress in 1960 to give all Americans the opportunity to benefit from investing in income-producing real estate. REITs allow anyone to own or finance properties. In the same way shareholders benefit by owning stocks in other corporations, the stockholders of a REIT earn a share of the income produced through real estate investment without actually having to go out and buy or finance property. This video provides some insight into what REITs are and how they work. The REIT industry has a diverse profile, which offers many benefits. REITs often are classified in one of two categories: equity REITs or mortgage REITs. Equity REITs own a wide range of property types, including offices, shopping centers, hotels, apartments, and much more. Equity REITs derive most of their revenue from rent on those properties. Mortgage REITs may finance both residential and commercial properties. Mortgage REITs get most of their revenue from interest earned on their investments in mortgages or mortgage-backed securities. In addition, REITs may be publicly registered with the SEC and have their shares listed and traded on major stock exchanges. Or they may be publicly registered with the SEC but not have their shares listed or traded on major stock exchanges. Or they may be private companies, not registered with the SEC and not listed or traded on a stock exchange. Regardless of the type, REITs operate under a specific set of rules established by Congress. A REIT is an entity that is modeled after mutual funds, is treated by the Internal Revenue Code as a corporation, must be widely held by shareholders, must primarily own or finance real estate, and must own its real estate with a long-term investment horizon. The IRS implements the REIT rules and oversees what qualifies as a REIT. The Internal Revenue Code requires a REIT to adhere to the following essential rules. At least 75% of the corporation's income must be earned from real estate as rent, real estate interest, or from the sales of real estate assets. At least 75% of the corporation's assets must be real estate assets. At least 95% of income must be passive. REITs are required to distribute at least 90% of taxable income annually to shareholders as taxable dividends. In other words, a REIT cannot retain its earnings. Like a mutual fund, a REIT receives a dividends paid deduction, so no tax is paid at the entity level if 100% of income is distributed. REIT shareholders pay taxes on dividends at ordinary rates versus the lower qualified rate. The top ordinary rate is now 39.6%. Over time, REITs and the rules and regulations that govern them have evolved to meet the changing needs of the real estate industry and the broader economy. But throughout that process, REITs have remained true to the mission laid out by Congress in 1960. To make the benefits of income-producing real estate accessible to anyone and everyone. And that's still how they work today.
So that's a little background on MREITs. On REITs, real investment trusts. So a couple of things to note there. Some of these REITs are on stock exchanges. Some of them you could buy that's not on the stock exchange, but it's still in SEC filing. Then you have private REITs as well. So you guys know Grant Cardone and his investment company. That's a type of a REIT. And then even in the black sector of YouTube, Jay Morrison, he has the Tulsa Real Estate Fund, which is not on the stock exchange, but at a point it's ran by the SEC, and people were able to invest in the Tulsa Real Estate Fund and get involved in real estate that way. And then, of course, if you go to a different shopping centers in your state or in the city that you live in, there's a couple out here in where I live where you got the Walmarts, you got the movie theaters, and you got all these restaurants. You may have a Best Buy in it. It's basically that whole shopping center is owned by a real investment trust, either a public one or a private one. The Walmart doesn't really own the building that the Walmart is in. They lease the building, or maybe Walmart may own some of the buildings, but a lot of these restaurants that you see, these small restaurants that you see, they are leasing the building that they're in, and more than likely a real estate investment trust owns the building, and they're able to get money because they charge rent to whatever person is leasing that space, so they're able to get money for that and get profits, and then they take that money and they pay that money across their shareholders. And to be a real estate investment trust, you gotta pay at least 75%. Some real estate investment trusts pay more. Some even pay out 90% of their profits back to their shareholders. The reason why real estate investment trusts pays profits up to 90% is because they are moving the tax implications on them onto their shareholders. This is why when you do your taxes, when you own a real estate investment trust, you get taxed as regular income as opposed to capital gains tax, because the real estate investment trusts are passing the taxes on to you. And since they don't have the tax burden, they're able to go out and expand, buy more buildings, sell buildings, and grow their business because they're passing on the taxes to the shareholders. But there's another REIT, another type of REIT that wasn't really talked about that I also want to talk about. We're going to talk about mortgage REITs because we got people out there that want to own homes. We got Reed Jones with a $2.34 super chat. Thanks for supporting the channel. But we gotta talk about mortgage REITs because you don't only want to own the building, but you also want to own the paper that's being signed. When you go out and finance a car or finance a house and you sign the deed and you sign all the paperwork, well, money is being exchanged through the paperwork, and that's where mortgage REITs come in. So you want to get in the mortgage game and get some of this money from the paper that's being signed. So we're going to watch a video on mortgage REITs as well. So this one's called Understanding Mortgage REITs. It's a 3-minute video, real short.
REITs typically operate within two approaches: equity REITs and mortgage REITs. Both provide investors the opportunity to benefit from real estate investment without requiring too much capital, and each can play a distinct role in building diversified investment portfolios. So what is a mortgage REIT, and exactly how does it help investors turn capital into income? Mortgage REITs, also known as MREITs, generate revenue from interest earned on their investments in mortgages and mortgage-backed securities. So when you invest in a mortgage REIT, you receive income from the interest earned on money loaned to property owners. Just like any other stock, including shares of equity REITs, the shares of mortgage REITs may be listed and traded on public stock exchanges, sold to the public but not listed or traded, or owned privately. Also, like other stocks, they can be bought and sold through your broker or online brokerage. There are also mutual funds and exchange-traded funds, known as ETFs, dedicated to mortgage REITs. Similarly, the value of mortgage REIT stocks fluctuates in response to market developments. Mortgage REITs invest in both residential and commercial mortgages and mortgage-backed securities. While most focus on either residential or commercial mortgages, some mortgage REITs invest in both. Most residential mortgage REITs invest in agency mortgage-backed securities, which are issued by Fannie Mae and Freddie Mac, or Ginnie Mae. Because they are backed by the federal government against default, agency residential mortgage-backed securities typically offer investors lower returns, but with low levels of volatility. Commercial financing REITs delivers returns from commercial mortgages and mortgage-backed securities, real estate loans, and other related financial instruments. Mortgage REITs efficiently channel private capital to residential and commercial real estate. This capital has helped heal the real estate sector following the financial crisis and provides the funds necessary for real estate to thrive and grow in the future. Mortgage REITs help build the financial foundation for providing credit to homeowners and business owners alike. At relatively low costs, mortgage REITs have historically provided investors a regular quarterly dividend, making them a popular way for investors to allocate capital in order to generate income. That income plays an important role in retirees' investment portfolios. So whether you're looking for access to the real estate finance market in your portfolio or want to diversify your holdings while gaining a source of dividend income, mortgage REITs may be right for you. Visit REIT.com to learn more. NAREIT is not acting as an investment advisor, investment fiduciary.
Stop the show right there. So that's a little information about mortgage REITs. So I had bought a lot of mortgage REITs. I bought NOY, I bought NRZ, AGNC, I bought Brookfield Property, I bought Prospect Capital. I bought so much mortgage REITs. They typically pay a fat dividend, anywhere from 8 to 15% depending on where the market was. But when the whole pandemic hit, these mortgage REITs, their stock price took a major hit. A lot of these mortgage REITs had to cut their dividend because of the low interest rates, but over time the stock prices of those mortgage REITs began to go up. And these companies who had these mortgage REITs who cut a dividend, not only did they restore the dividend, they even increased the dividend over the time as things wasn't really as bad as everybody thought there was. People, like I said yesterday, people thought that these companies wouldn't be able to pay their rent. So if you owned a restaurant in one of these big shopping centers, or you employed people at a industrious center or whatever, there was a big scare that these companies wouldn't be able to pay the rent back to the lease, and it was going to stop all the money. But as we saw, a lot of these companies were able to maintain and pay back on their lease or on their loans or whatever agreement they had, but whoever they were doing business with. So that whole sector, it hasn't recovered all the way yet, but they recovered a lot. Another type of REIT, or another stock that acts as a REIT, is a MLP, a master limited partnership. So a master limited partnership is, hold on, we got a $5 super sticker from Justin March. He says, keep up the work. Let's see who else we got in the chat room. We got what Rollo says, shareholders pay the elite. That's true. That's true to a certain extent. But at the same time, the elite pays the shareholders, and you're able to make an investment on your money, and you could get involved in some things. But an MLP, or a master limited partnership, is a company organized as a publicly traded partnership. And the reason they're, I guess, structured that way, because it's all to do with taxes. So you will see a lot of oil stocks, a lot of pipeline companies. This is where you're going to find your MLPs. This is why oil companies and those pipelines pay such a massive dividend, because it's the way they have their business structured. Again, they're trying to take the tax burden off themselves, and they're putting it on the shareholder, but the shareholder is getting a higher dividend in return than if, say, they were to invest in another stock that pays dividend, such as a Pepsi, such as an Apple, a Microsoft, or whatever other stock that pays a dividend. The reason why their dividend yield is far so highly is because the tax burden is being passed on, and they're passing on more of the profits onto their shareholders. But when a company passes more dividends to their shareholders, they don't have as much money to grow their company, because they're not reinvesting their profits back into their business. They're paying it to their shareholders. So that's another risk that you have with these real estate REITs as well. Sick Lid says, got my money in V&Q, holding for over 20 years. Okay, that's good. Yes, if you could hold an index fund or a good stock for over 20 years and put money in it on a consistent basis over 20 years, you're going to make yourself a whole lot of money. We got Deja Vu Griffin says, the Grandmaster Troll breaks down the stock market works and gives some creative ideas to getting started in investing. Yeah, that's all it is. You got to have somebody to give you a creative and fun idea to get you involved in investing. That's why I tell people, open up your cell phone, take out your online banking, look at all the companies that you shopped at in the last 2 months and start investing in those and start to gain some knowledge. That way, when you get better at investing, instead of going in it cold like I did and getting hit for the first 1 year, 2 years losing money, when I finally figured out what I was doing, I was able to actually make a lot of money because I had the right resources and I knew where to go and find things. But we're going to talk about MLPs and what they are, master limited partnerships, and what they are, and what everything is about. So we're gonna focus. I won't play this whole video because this one's a little bit long, and it's not one of those educational videos. No. I'm gonna show you guys a YouTuber who gave me a little bit of knowledge in the REIT game, in the MLP game. He showed me how to do some stuff, showed me how to navigate the taxes and stuff like that. So I'm gonna introduce y'all to Bowtie Nation, my man Joseph Hogue.
How would you like to get some of the highest dividend yields in the market, cash returns as high as 9% a year, and never have to pay taxes on it? This is a loophole in the tax code around master limited partnerships that few investors know about. In this video, I'll detail this cash flow investment, the pros and the cons, and show you how to get that huge tax break. We're talking MLPs Explained today on Let's Talk Money.
Beat that. Make money. Make your money work for you. Creating the financial future you deserve. Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, there are a few stock groups that provide the cash yield you get with master limited partnerships, or MLPs. In fact, based on the ETFs around some of these dividend themes, MLPs set the bar with an average 9.1% annual yield. That's above what you get with mortgage REITs, more than twice what equity REITs pay, and more than 4 times the dividend on the overall market. These cash flow machines are a staple in my portfolio, and there's actually a little trick in the tax code where you can get almost all the dividend completely tax-free. And we're not talking about retirement account tax-free where you owe taxes later. I'm talking 100% tax-free forever. But there's also a lot of misunderstanding around these MLPs, from how to analyze them to filing your taxes. So I wanted to make a one-stop video for all your questions. Now I've put a clickable index in the video description below to show you what we'll cover and let you jump ahead if you don't need some of this basic stuff up first. At the end of the video though, I'll also reveal some of the best MLPs in my portfolio, so stick around for that. First, what are master limited partnerships and how do they make money? MLPs are special types of companies set up to hold assets, usually oil and gas pipelines, storage, or export terminals. Under this special type of partnership, MLPs pass their profits and their expenses on to investors and then pay no corporate income taxes. Now that means 2 things. First, these are a super efficient type of business, being able to skip those corporate taxes that hit every other company in the market. Second, though, it means massive cash flow to investors because these companies pass almost all their profits straight through every single year. Now, because they use that special type of partnership, taxes are a little different for MLPs, and I'm going to show you how it all works out, including that special loophole where you can get all those dividends tax-free. So master limited partnerships own those oil and gas pipelines. They make money by charging oil companies to connect to those pipelines and send their oil through the refineries. An example here, Enterprise Products Partners, ticker EPD, is one of the largest MLPs with over 50,000 miles of pipeline, storage, and processing centers all over the country and 18 deepwater export facilities. So think of MLPs as a toll road, charging oil companies to use its pipelines, storage, and processing centers. Now, one of the advantages to this kind of business model is that profits aren't directly tied to oil prices. Now, a lot of the sales here come from a charge on the amount of oil or gas moved through the pipelines. So MLPs make money moving higher quantities through the pipes, whether oil prices are higher or lower. So you've got these companies spinning off massive amounts of cash. And I want to first give you the short version on taxes here, because this is where investors get that bad information and end up not investing. I'll first show you the basics on how these things are taxed, plus how to get those dividends tax-free. Then later in the video, I'll show you exactly how to fill out your taxes for these investments. So when you invest in a master limited partnership, each year you're going to get what's called a K-1 form to show all that pass-through income and expenses on the partnership. Now this is what throws a lot of investors because they see this form and just think it's too complicated or it's going to cost them to hire an accountant. They just avoid the investments altogether. It's a big mistake though, because doing your taxes on these really isn't that complicated. Any tax software like TaxAct or TurboTax can do it, and I've seen investors do it manually as well. So the MLP is going to report your share of the business here, the income minus expenses and that depreciation plus those dividends. The beauty of this is that the dividends you receive throughout the year, those aren't all taxed. Only part of those dividends are going to show up on that box labeled ordinary or qualified dividends. The other part of these dividends you received, and this is usually between 80 to 90% of your dividends, so the vast majority of those is counted as a return of capital. The IRS actually considers this a payback of your investment in the company instead of cash flow, so you don't pay taxes on it right now. Now I know this can be confusing, so I want to explain this a little bit more. Say you buy a share of EPD for $29 and receive that $1.77 in dividends during the year. So let's say that 18% of that is counted as that dividend and you pay taxes on it. Easy enough. But that remaining $1.59 that you received is counted as a return of capital. In effect, it lowers the tax costs you paid on the shares. So in the eyes of the IRS, instead of paying that $29 each for these shares, you now paid $27.41 each. Of course, like any stock, when you sell it, then you pay those capital gains taxes on the sales price minus how much you paid. So if you sell your shares of EPD, you'd pay taxes, those capital gains taxes, on whatever you sell it for minus that $27.41, which is that adjusted price. So most of the taxes on your MLPs is going to be through that capital gains when you sell. But here's the trick. Here's that loophole that you never have to pay taxes on these. Now, this is going to be a little morbid here because we're talking about your death, but the IRS says that these pass-through investments are marked up to market value in an estate. So if you were to die and that share of EPD with the adjusted cost basis of $27.41 goes to your heirs, the shares actually get counted on their taxes at that current market price of $29 each. They get the shares at that price and then just start counting their own capital gains from there. So the trick here is to never sell your MLPs. You can be collecting those dividends for decades, never paying taxes on them. Then when you pass those through to your heirs, the cost basis is marked up, wiping out that adjusted cost basis you had, and it's like those dividends never happened. They just disappear in the eyes of the IRS and nobody owes taxes on them. Now, I do want to throw in a disclaimer here before we look at that special way to analyze MLP stocks. And
I'm going to go ahead and stop the show right there because that brother was dropping some knowledge right there. So I actually, when the whole crash happened, I actually bought a couple of shares of EPD Enterprise, EPD stock. And I bought it. It was at like $15. It was paying a massive 17 to 18% dividend, and they did not cut the dividend. It was really a good investment, and the stock price actually went up almost 80%. So I made some good coin investing in that company. And of course, as you can see here, you also get the tax. You get no taxes if you follow the directions. So what you need to do, because I'm not going to give you all the information for free. I'm not going to give you all this good game for free. What you are going to have to do, you're going to have to go to my man's channel right here. Let's see if I can pull it up right here. He's one of my favorite people who talk about stocks on YouTube. But you gotta go to my man's channel, Joseph Hogue. Subscribe to his channel. He's got some game for you guys that y'all need to go watch. So that's a little bit about MLPs. There's a lot of MLPs, like you said, pipeline, oil, gas, storage. A lot of those companies do MLPs. They pay massive dividends. So all you people looking for dividends, I believe I Am Verbal, she was looking for stocks with massive dividends, EPD stock. That's something you're gonna have to look at. But other than that, I'm gonna go ahead and drop the link because I'm just about done with my presentation. I went through all my slides, it looked like. Yes, I went through all my slides, it looks like. So I'm going to go ahead and drop the link. And if anybody wants to come up, talk stocks, if you have advice, questions, some knowledge to give, come on the Grandmaster Troll channel. Tell us what you got for us. If not, I'm going to go ahead and shut this down because it's 8:30. I could finally go somewhere and make some videos for my Grandmaster Troll channel. I was 35 minutes late today. I wanted to come on at 6:30. It took me 7:05, 7:10. So I was like 35 minutes late today. Got to get better about getting on time because I want to hit it when the market is open, so we could go ahead and trace the market and see the things that's going on. But before I do that, I'm just talking about the basics here, because I know there's a lot of people who aren't involved, want to get involved. So I'm gonna start from the very basics, and I'm gonna get more advanced as we go forward. As we talk about a certain thing, let's see what's up today. Okay. Let's see if I can open up the Robinhood account real quick. See what we find. See what we could find on the Robinhood account today, and I could demonstrate to you people how rich people is getting rich. So here's a stock today. Here's a stock that I saw today. We got Frank Internationals. Frank International's NV engages in the provisions of tubular services to oil and gas industries. It operates through the following 4 segments: tubular running service, tubular and cementing equipment, blah, blah, blah. So that's what they do. But this stock is up 40%. And at one point today, it was up 50%. So imagine if you had $1,000 invested in this nondescript company that nobody's never heard of. You got $1,000 in there, and you woke up on a Tuesday morning and your $1,000 turned into $1,500. It's a good day. Imagine if you had $10,000. Now you have $15,000. Imagine if you had $100,000. Now you have $150,000. You just made $50,000. The average salary of an American worker, in fact, more than the average salary of an American worker, in a couple of hours. That's the power of investing. That's what day traders do. They're able to know which stock is going to be up 30%, 20%. So they'll have them for a couple of days, or maybe even the same day buy the stock. It'll pop. They'll sell the stock. They'll pay the taxes on whatever they gain, and they'll live comfortably off the profits. I don't day trade because I just don't have the knowledge, and I don't have the risk tolerance to day trade. I'm more of a long-term investment. So tomorrow, that's what I'm going to do. Tomorrow's video will be about different investment strategies, so people will know the different investment strategies available to them. So those people who are nervous, a little bit scared, a little bit timid about investing in the market, they will actually be able to see different investing strategies, how to do different investing strategies, but more importantly, go to the people who are successful at these investment strategies, team up with them, watch their content, maybe even pay for a course to get the knowledge in which they could use in their own everyday life. So I'm going to do that video there. I'm going to see if somebody joined the StreamYard. If not, I'm going to go ahead and close out this video, because I got some things I want to do today, and I want to finally set up my channels and have content on everything, new content. I just got to edit this vlog. I think tonight what I want to do tonight is, of course, do a troll video tonight, and then I actually want to show you guys how I use Adobe Premiere Pro to edit and do vlogs, and you guys could input things that I put into the vlog. Maybe there's a sound effect, or maybe you just have questions, and maybe you're looking to get into editing videos yourself. Well, I could edit, because it takes a long time to edit. If I could get 100 people to watch me edit, I could at least make $3 while I spend all these hours editing these videos. So with that said, we got Dwayne. He says, "Go racing. Who are you trolling?" Oh, I'm thinking about getting Bomb Cherry. I'm thinking about trolling Bomb Cherry. That's what I'm thinking about, trolling Bomb Cherry, because she said she was the first webcam model, and when I searched who was the first webcam model, I found some interesting information. So I'm really thinking about doing that show. That show's been on my mind ever since she told that story about her being the first webcam model. But with that said, it looks like nobody joined the stream, y'all. So we're going to go ahead and end this one nice and early. I want to thank all the people. Who came and supported, who either liked the video, watched the video, hit the Cash App, or hit the Super Chat, rather. But y'all know who it is. It's your boy, the Grandmaster Troll. Peace.